Hey, Dan Passarelli here. I'm often asked about trading channeling stocks or range-bound stocks. So let's first talk about what they are, and then we'll talk about how you can trade them. So first of all, it's really very, very simple. A stock that is range-bound, meaning trading within a range, or trading in a channel, those are synonyms, are simply stocks like this one, World Wrestling Entertainment. WWE. I'm looking at a weekly chart, or excuse me, weekly candles over, looks like a 3-year period. So this is a little bit of a longer term view. Now there's a couple of ways to identify the channel. Actually, I guess there's just one way if you think about it. If we can identify a resistance level, and as you can see here, this is a pretty strong resistance level. Not only is it forming basically a triple top up here, but if we go back a little bit further, this was a pivot point back this way. And then we would also identify a support level. And here we have like a double bottom. And if we go back here, it also was a pivot point. So we've got a little W for WWE, I guess, right? So this stock is trading in a range. If you're an investor, a long-term investor just owning this stock, you probably end up getting pretty frustrated because you're not really making any money on it. You make a small amount of dividends, but it goes up and it goes down. To actively trade it, what we can do is a couple of things. One is, especially because these are weekly candles, when we get back down to support, we can do things like simply buy calls but the problem with that is when stocks go down, their implied volatility goes up, and so those calls can end up getting more expensive. On the top side, when the stock goes up, we can buy puts, looking for it to go back down and bounce down below resistance. And those puts might be affordable because implied volatility tends to go down when the stock goes up. Now that said, there's other ways to go about this. We can also capitalize on implied volatility when it falls and also give ourselves a little what I call wiggle room and do this. We can sell put credit spreads. We can simply sell a put somewhere below support, maybe in this case, say the 45 strike, and buy a lower strike, 44, 43 strike. And we can do this, we would definitely want to model out the different time horizons. I typically like to stay under a month. And then, of course, if it goes back up and we still have the put credit spread on, we could consider selling call credit spreads. But because we have this sort of oscillation within this range, we might want it to go up a fair amount before selling the call credit spread. If we're able to do both, like a scenario like right here, where we get a little bit of interplay within the channel, we could do both, selling a put credit spread and a call credit spread, which is called an iron condor, and we'll do some videos on that in the future. This is Dan Passarelli. I hope that helps. Trade smart.